Thank you very much. Certainly do encourage you to ask me any tough questions you like. For obvious reasons, we've had a lot of conversations over the last month or so regarding market structure, nuances of specific to ETF product structure, and a number of topics that go into that. So certainly happy to discuss any thoughts, questions, concerns you have around those topics. Or anything ETF related in general. I'd like to provide a little historical context when I talk about ETFs and market structure in general. It's a relatively new part of the financial world. First ETF was just launched about 22 years ago, which in the grand scheme of things is probably not a long history for a product. It's only within the last 10 years or so that we've really seen a significant increase in ETF assets year over year and widespread use of ETFs. One of my colleagues in the industry likes to say that ETFs have democratized trading, democratized investing, and allowed clients of all types and all different segments of the investing world to express their interest on certain asset classes and in a number of different ways that were previously unavailable. They're able to do that today in a more liquid, transparent environment than has ever existed previously. And we continue to see the ETF industry grow, both in assets in the pre-existing products, but also in terms of different product types, products on different asset classes that were never previously available. And we're excited about the future of that growth, but we also understand that we need to consistently evaluate the impact of that growth and the circumstances within which that growth takes place. So, I have that as an introduction. I'll just give you a quick primer. I'm going to talk a little bit about the history of ETF market structure, kind of some very brief basics on ETF mechanics, jump right into the events of the 24th, which I believe you all have this brief handout on the table in front of you that goes into some detail on that, so I'll be referring to that. And then touch briefly on any questions that you have. We'll have about 15 or 20 minutes for question and answers at the end, so I'll ask you to hold those unless there's a specific question that you just you can't hold back on. Happy to take those as well in the middle of the talk. So I started in the ETF industry a little over a decade ago. I was an ETF market maker for Goldman Sachs on the floor of the New York Stock Exchange, and then on the floor of the American Stock Exchange. That was a drastically different market structure than what we have now. It was a floor-based model. We had a lot of human interaction. When I started, it was actually quite manpower intensive. We literally had to type in a market throughout the day, all day, type in the price and the quantity that we were willing to buy and willing to sell. It was very manual, very, very active all day. Over time, due to various regulations that have come into play, that market structure has changed quite significantly. There was a period between that manual typing in of orders and manual responding to buying and selling interest with liquidity in the market. There were human beings on the floor who were bidding for stock when investors were looking to sell, or offering stock when investors were looking to buy. It was a very interactive process that allowed a very thoughtful price discovery mechanism. By today's standards, it was an incredibly slow process, and certainly we have an advantage in today's markets. They move much more quickly and much more efficiently, but we've lost a little bit of that element of, frankly, common sense and human intervention, which dovetails into the events of the 24th. At the end of 2007, most ETFs moved from the floor-based trading model on the NYSE to NYSE Arca, which is an electronic trading platform. Trades, rather than hitting the market and having an opportunity for market makers to respond, at that point would come into the market and automatically be executed against whatever the best market was available at the time. At the end of 2008, the NYSE acquired the American Stock Exchange. There were a few ETFs that continued to trade on the floor of the Amex up until the end of 2008. The very last product to move off of the floor-based trading model up to the electronic trading model was SPY. And that was actually the last floor-based specialist for SPY, which is kind of an interesting situation and interesting perspective to be there, both in the times of manual trading that was largely human-driven, to see the hybrid between the technologically based trading platform and still some human involvement, all the way to where we are now, where most trading, just about all trading in ETFs is completely automated. So with that, I'll start with the events of August 24th. The environment going into trading on the morning of the 24th was a very, very unusual environment, an environment that most investment professionals that I know and have spoken with have not seen in their entire career. Certainly during the flash crash in May of 2010, we had a significant event of market volatility, but that was an event that took place intraday and was driven by a drastically different set of factors that came into play on August 24th. On the morning of the 24th, we had a massive sell-off in China, which flowed through to massive sell-off in Europe, which led to the pre-open for our market in the U.S. With futures trading limit down. Dow and S&P futures were at the lowest level we've seen in quite a while. You see the numbers here in the handout. And typically what we have in a normal set of circumstances when the market opens is we have relatively quick, I wouldn't call it instantaneous, but relatively quick liquidity formation and price discovery. Most products open within the first minute of trading. Most individual equity securities open within the first minute of trading. And we have a very good understanding of the value of the underlying basket of securities that goes into the pricing of exchange-traded funds. On the morning of the 24th, for various reasons, there was tremendous uncertainty in terms of the opening of the underlying individual equities that comprise ETFs. ETFs are on an electronic trading market. They open right at 9:30 based on the supply and demand in the market, and they trade from that point on. The stroke of 9:30, they're open for trading, and they're off to the races. The only securities that don't operate in that manner are individual equities that are listed on the floor of the New York Stock Exchange. There's an opening auction that takes place for those individual securities, and they are subject to a slightly different set of rules and regulations as they open. I'll dive briefly into those rules and regulations and happy to go into greater depth on those. Essentially, you have a supply and demand at the open at 9:30. You have buying and selling interests that a human being will match up if necessary. If there's a large imbalance, if the security is going to trade outside of a certain band, under normal circumstances, there's a set of opening procedures that's in place. NYSE Rule 123D defines those procedures. So those procedures include things like disseminating an imbalance and a required waiting period of 5 minutes, getting approval from a floor governor to open that trade outside of that band. To the extent that there's a change in the supply and demand dynamics in the market over that 5 minutes, there's another issuance of imbalances, a publishing of imbalances, and another waiting period around that. So it's a process that is drawn out in terms of time, but really maintains what the NYSE will call the sanctity of the price discovery process, allowing market participants the time to understand the buying and selling interest in a given product, and allowing a process of intervention and reacting to that buying and selling interest to arrive at a price that is the right price to open that product. It's a drastically different market structure philosophy than the electronic markets, which simply open at a time regardless of the supply and demand interest in the market, and essentially allow market dynamics to determine fair value for that product over time. If there's a huge amount of selling interest and really no buying interest, under that electronic platform, stocks will tend to open down drastically for obvious reasons. The thought process and the human intervention that goes into the floor-based model allows for some more kind of logical intervention in that process. The Rule 123D that I just described is typically in place on individual securities under normal market circumstances. If there's something like news or a corporate action on a certain security that will drastically affect its price, but the rest of the market, is opening under normal circumstances. That's when those requirements come into play. On the morning of the 24th, because there was a widespread market shock, and it was widely understood that that most securities, if not all securities, will be opening outside of those bands, there was another rule enacted called Rule 48 that I think we've all seen and heard a lot about in the media, and has largely taken the blame for the slowness in opening securities. Rule 48 was actually designed to speed up that process. What Rule 48 does is it takes away all of the time and dissemination and approval requirements that are in place with Rule 123D. So the idea there being, if we eliminate these waiting periods and the requirement to find a floor governor and get approval to open a security, we can open them more quickly with the understanding that, obviously every security is going to open at a level that's drastically different from the prior night's close. Rule 48, some would say, worked in the way that was expected. The downside to Rule 48 is there was a lack of dissemination of imbalances, so lack of information available to the market. So even though in theory Rule 48 allowed securities to open more quickly, the imbalances were such that when those securities did open, market makers were facing what to them was overwhelming sell interest, and again, no real sense of the actual value of those securities. There was quite a bit of time and quite a bit of intervention of volatility halts that took place prior to the flash crash in 2010. The SEC mandated that exchanges put bans in place beyond which securities had to be halted for trading for a brief period of time, 5 minutes. I guess that's not necessarily brief in the grand scheme of trading and market dynamics, but the idea behind volatility halts was to allow the market a time to take a breath, take an opportunity to step back, and prevent sort of a cascade of selling as we saw during the flash crash. The idea being that if a security trades a certain amount away from its last sale in a certain amount of time, and it depends on which security and how that security is classified by the exchange, what that band is and what that amount of time is, that security will enter a volatility pause. Everyone takes a step back, everyone has a look at what's really going on in the market. 5 minutes later, the stock reopens for trading, and the idea was that cooler heads would prevail at that point. Unfortunately, what we ended up seeing on the morning of the 24th with a lot of the volatility pauses was that the trade that triggered the volatility pause also triggered a lot of stop orders. And stop orders typically turn into market orders to sell. So you would have a stock that would hit a volatility pause. There would be an understanding of what the imbalance would be coming out of that volatility pause. The market makers would attempt to match that volatility at whatever level they deemed appropriate at the time, but then there would be another wave of sell orders immediately triggered orders to sell at the market. So that cascading effect was certainly slowed by the pauses. It's something that would have taken place in a matter of seconds or fractions of a second in the absence of those pauses, but nonetheless was still an issue. It didn't eliminate the issue. It certainly mitigated the timing of that issue. The challenge with those pauses is that it mandates a 5-minute period or 5-minute increments during which there's no trading in that security. So when you're trying to price an ETF that has an underlying basket of securities, and you have securities that are either not opening at or around 9:30, or securities that are hitting these volatility pauses for 5 minutes at a time, it becomes more challenging. Again, that process of price discovery becomes delayed. Market makers in most ETFs, used proxies, used adjustments from final sale, look to points of reference that help them understand what they thought the value of the ETF should be at the time, and they use those points of reference to continue to make markets in most ETFs. But there was certainly a limiting factor due to those securities being delayed in terms of opening. There's a chart on the second page of the handout which illustrates the amount of NYSE securities that were open for trading at certain times during the morning of the 24th. As you can see, at 9:30, the stroke of 9:30, only approximately 20% of NYSE listed securities were open. By 9:35, you had a number still under 40%, around 36%. It wasn't until 9:57 that all of the S&P 500 securities were open. That's a term ETF market makers call the cash open, when all the underlying securities are open for trading. The cash open typically takes place within a few minutes of 9:30. On the morning of the 24th, it took almost a half an hour. So the cascading effect of the delayed price discovery on underlying securities certainly flowed through to the trading of a lot of ETFs. Our largest ETF, SPY, the largest and most liquid ETF in the world, by most standards, traded well on the morning of the 24th. There were no volatility pauses on SPY. SPY traded almost a little north of $97 billion notional. That's the most notional value that any security has ever traded in the history of the world in a given day. So it really was a safe haven and one of the few securities that the market could rely on to have access to express their views in the market. Yes?
Can you just back up and just say again what you were talking about as far as using some sort of indicator?
Sure.
Like a matrix price or some other that, and I apologize, by the time you get to the end, that might not be the right time.
Yeah, no apology necessary. It's a great question and perfectly timed. So this is a process that I think when most people think of ETFs, they think of domestic equity ETFs, and they think of you have an underlying basket of securities and you have ETF shares. And at 9:30, both open, so you have a very good understanding based on where the underlying securities are trading, what those ETF shares are worth or should be worth. And if there's any divergence there, you can, let's say the ETF happens to be trading at a premium to that value of the basket of underlying securities, you can sell the ETF shares, buy the underlying basket, and lock in that arbitrage opportunity. That's the process that keeps the price of the ETF in line with the price of the underlying basket of securities. There's an arbitrage opportunity. And that's the way that ETF markets work under most circumstances for domestic equity ETFs. There's typically a period of time, a minute, 90 seconds, 2 minutes, depending on the underlying securities, where market makers can't actually affect that trade because the underlying securities aren't necessarily open for trading. So there's an amount of adjustment that goes in. Maybe they have 80% of the basket open and they know that the other 20% will open generally down 1% if the market is down 1% or if the sector's down 1%. They factor that into their pricing, but they do have a little more risk. They don't have that airtight arbitrage trade that they can put on immediately. In the case where there's a significant amount of the basket not open, which typically happens with US listed ETFs that are based on foreign indices, we see this process of applying an adjustment factor to previous closes or looking at other proxies for pricing throughout the trading day. It's certainly not something that's foreign to ETF markets. I think it's something that is one step removed in most people's understanding of how ETFs work, but it's something that's commonly done in ETF market making. Now, what you'll tend to see in those types of products is slightly wider spreads to account for the added risk or uncertainty that exists in the price of that fund or the cost of putting on that perfect hedge on the other side of the trade. And we've done a lot of deep dives and happy to define arbitrage bands for any client who's looking at our funds. Yes, sir.
Just talk about why it seems like that arbitrage process is stepped away. Is it because the banks and other participants aren't committing as much capital as they were 2 years, 4 years, 5 years ago? Or are we looking at that as should they be required? It seems like at the most needed moment, the capital wasn't there.
Correct. Yeah, it certainly seems that way, and I think you touched on one of the many factors that came into play as to why it appeared that market makers stepped away. Market makers are certainly under more regulatory scrutiny than they ever have been, just as are all other market participants. I think it was less about hitting capital limits and more about hitting risk limits and requiring risk checks. So the way most market makers are set up is they have an automated process to quote in most ETFs based on whatever proxies they put in, based on either the underlying basket of securities or some combination of that, plus an adjustment factor, futures, or any other factor that they deem appropriate to help price that ETF. Whenever there's a circumstance that goes outside of the parameters of that pricing model and that system, it requires human intervention. So there will typically be somebody on the desk who has to check that security, have a look and say, all right, this looks reasonable, I'll reopen that security or reopen that quoting process. So it's a risk check that's in place on a lot of market making desks that they have to have a human being look at it, which makes total sense and works fine in a normal trading day. Let's say you have a market maker is quoting in 1,500 ETFs, and maybe one or two at a time are going off, and they have to have this manual intervention process and check. And they're typically somewhere between 2 and maybe up to 10 for really robust operation human beings who have the knowledge and expertise to do that. On the 24th, you had something like 1,000 or 1,500 securities requiring that human intervention. So certainly the process that was designed for normal circumstances fell down a bit. You would have needed hundreds of traders to really reopen those products for quoting within that market maker system in a timely manner. In many cases, there were lists of hundreds that traders would have to go through and say, that one at a time. And even if they did that in an extremely quick manner, it would take several minutes or more to come back into the market. There were also situations where there was connectivity issues between the market itself and the market makers. So market makers were ready and willing to quote in a product, and they were trying to send it in order, but that product might have been halted for trading in a volatility pause or having some sort of other issue that prevented the market maker from actually accessing the market. There are a few more risk parameters that are in play now than were ever in play historically. In the wake of the night trading issue back in 2012, where they lost almost $500 million in a matter of seconds and became insolvent, there are many more risk parameters in place, not just mandated by the SEC and the regulators, not just at the exchange level, but also at the market making level. Many of the market makers we talk to, and one of the roles of my group is to have constant connectivity with the authorized participant market maker community. If there is ever a product that has a wider market than we expect to see or is trading in an unusual manner, we immediately reach out to the lead market maker in that name, and in some cases other market makers who we know are active in that name, to check if there's something unusual going on. Is there an underlier halted for trading? Is there some other risk factor in play here that we're not aware of? When those cases do arise, we like to let our sales team know so they can let our clients know. You have an interest in a name that typically trades a nickel wide, now it's trading 30 cents wide, and here's what's going into that. Here's the reasoning behind that from the market maker's perspective. Certainly something that on that day we got a lot of feedback that market makers would have loved to have stepped back in immediately. Obviously, the levels at which some ETFs and some individuals' securities were trading at were levels where people would have loved to have bought shares. We've heard this both from institutional clients and from market making entities. And unfortunately, due to a lot of internal risk metrics and regulations imposed on market makers from a risk perspective, they weren't able to do that as quickly as they would have liked.
So like Apple is an example. Trading going from 110 to 96 or whatever, and that it seems to me that along the way there should have been more people that trading in Apple shouldn't be. If you're that person sitting at the market maker's desk, the largest cap company in the world, are they opening up?
Are we really down 10% on Apple? Right? Yeah, no, really, we're down 10% on Apple. I'd love to buy it down 10. And this goes back to the state of mechanics and kind of the role of market orders and stop orders. Market orders were a big factor on the 24th. Stop orders, which became market orders, were a big factor on the 24th. In my opinion, market orders are a dinosaur order type. Market orders made a lot of sense in the old market structure that I touched on earlier in the talk, where you had the ability of liquidity to meet buying and selling demand in the market. You would have a market order come in, let's say a security's trading at $100 per share, market order to sell. The next best bid for whatever reason is down at 95, all right? Under the current market structure, there's no ability for anyone to step in and say, oh, I'd sell it better than 95, we have a market order, or I'd buy it better than 95, we have a market order to come in to sell. Under the current market structure, that market order executes immediately against whatever the best bid is available.
I say one of the problems with that is that bids were so bad. That with that type of liquidity, once you do market orders.
Fair enough, depending on what your goal was in that trade. And I'll just quickly finish the discussion of this process and then definitely touch on your question. The old market structure would have allowed the ability for market makers, liquidity providers to step in response to that market order. For market order to sell, last trade was 100, best bid's 95. That order under the old market structure didn't automatically execute. It allowed the opportunity for liquidity providers to come to the table and say, I'm 96 bid, I'm 97 bid, I'm 98 bid, 98 and a half. 98 and a half is the best bid. That market order would then execute against that 98 and a half best bid. So there was an opportunity to respond to liquidity interests. Under the current market, it's instantaneous. If you put in a market order to sell, there's no ability for liquidity providers to respond. And there's no ability for liquidity providers to have a common sense, logical interaction with the market. Let's say, previous example, last trade was 100, stock trades at 95, market maker recognizes this immediately and say, I'd love to buy as much as I can at 97. Market makers enters a 97 bid. At that point, stock is traded down another leg to 90. Exchange rejects that 97 bid because it's outside of the parameters, or would push the stock back into a volatility halt. So the state of market structure moves so quickly and doesn't allow for a meeting of liquidity to match buying and selling interest in the very, very short term. And it's certainly one of the things that's being looked at. There are a number of things that are being looked at in response to the events of the 24th. A lot of conversations have gone on between the issuer community, a lot of the large broker dealers, the exchanges, regulators, to try and figure out what happened, what specific issues were the main drivers of the events of the 24th, and what can be done to mitigate those issues. I don't think there's anyone who understands equity markets who will tell you that the markets were ever perfect at any point. I don't think there's anyone who'll tell you that they'll ever be perfect at any point. We'll take opportunities like the 24th to learn what we can do to adjust market structure and some of the parameters that have been put in place to mitigate those circumstances and make them better. There are a few items that I think have been or will be enacted in the very short term to help mitigate that. The changing of the bans for volatility halts is certainly something that I think would help. The changing of timing around those halts, 5 minutes of a halt is quite a long time. The changing around disseminating of buy and sell interest around those halts would certainly be something, but the pendulum was certainly too far to the solely human interaction-based market 10 years ago. The pendulum has swung beyond what was probably an appropriate level in terms of the electronic trading and the speed of markets. And there's going to be there has to be a happy medium of those two elements, some way to have liquidity come to the table and meet buying and selling interest at levels that I think most people who looked at the trades that went up that day in certain securities would all agree that doesn't make sense. And one thing that I always point back to when people ask me about arbitrage on ETFs and why is this market here, One thing that always comes up in that conversation is who's involved on that end. It's very, very well capitalized, with the best technology and the smartest people, trading desks that are interacting on those securities on a day-to-day basis, and they are not playing for huge wins. They're not playing for home runs. There's an old saying that market makers eat like birds. They're playing for fractions of a penny, little pieces, and they're looking to do that thousands of times a day, and then over time they build up profits. That's the state of market structure. That's a natural circumstance in the financial world where you have a set of rules laid out and you play to the best of your ability under those rules. On a day like the 24th and the event that happened with Knight a few years back, you have market makers who are making fractions of a penny 1,000 times a day, and then all of a sudden, in an instant, they're losing a year's worth of profits or more. And again, finding that happy medium of risk versus reward under those circumstances is a big challenge. So I wouldn't say that market makers necessarily voluntarily stepped away and didn't buy shares at levels that were obviously, very advantageous levels. I think they were prevented from doing so due to the way they're set up to work under normal circumstances. And then when you apply that to the context of what happened on the 24th and the sudden and severe nature of what happened on the 24th, and the fact that once you got to a level where you said, all right, we had 1 million shares to sell and nothing to buy, and we've found our way through that. We found a level at which those shares to sell will pair off with buying interest within a volatility halt. All of a sudden, you have millions more shares to sell because stops were triggered and market orders went into play. So it's a confluence of different factors that came together to cause those events. It happened for a very brief period of time in the grand scheme of things. Seemed like an eternity at the time. It always does, even if these things only happen for seconds, because you don't know if they're going to last for hours or if there's some major, did a nuclear bomb go off somewhere, or is there some really major global event that really does justify the market being down 10 or 20%, or is this something where 5 seconds later or 5 minutes later we'll snap back? On the morning of the 24th, it took about a half hour. For the rest of the day, everything traded as we would expect. If you look at a lot of the examples of individual securities, we would see probably 95 to 99% of things working as they should and things trading as they should. That 5% at certain stages down to 1% at other stages certainly didn't work, and there's no doubt about that. And I think focusing on what can be done to resolve those issues and mitigate future events is certainly the focus right now. Yes, sir.
Is there any information about all the different market participants, retail self-directed investors, funds, wirehouse brokers, market makers themselves, sort of one who's lost in all that? Like, who's out there that those orders go in and stop loss orders at 9
Right. I don't have a lot of specific data, but I have seen some anecdotal data that indicates that it was largely the retail investors who were drivers of the market orders that came in, whether they were pure market orders, people hitting the panic button and just say, I want to sell at whatever level I can sell, or people who had stop loss orders in place, which then converted into market orders. Again, in this environment, a market order doesn't make sense. A market order is a limit order to sell with a penny limit, regardless of what you think the security is worth. I think what a lot of people think a stop loss order is, or even in most cases a market order is an order to sell at what I see as the best bid when I decide I want to sell that security, or I'll be stopped out if I have a stop loss order. If I'm long the shares from 100 and I don't want to lose more than 5%, I'll put in a 95 stop and I'm good there. That in theory makes total sense. In practice, there are circumstances where your stop might be triggered at 95 and the next trade might be down a lot more. And I don't think that sits well with anyone. I don't think that's the intent of any trader, any market participant, when they put in a stop at 95 to be selling shares down at 80. And there are other ways to get that sort of protection on your trade. But I certainly, and this is my personal opinion, I don't see any reason to use a market order at any point. You can use a marketable limit order. You see a 95 bid and you're willing to sell down to 90 or 92, you want to get out. Put a low that's through the best market at the time and give yourself a chance. I think we see too many people when they're trying to execute trades who genuinely want to get the trade done, using an order type that doesn't make a lot of sense. We spend a lot of time, we have a few different people in my group who work with different client types. Spend a lot of time educating around that. Spend a lot of time trying to help people understand what type of order types will get them to the goal that they intend to hit. It's fine. Oh, I'll put a stop in. I'm stopped out at 95. Maybe, that's the idea, but there are certainly other ways to do that make a lot more sense.
Did you answer his question on who you thought gained from all of that?
Yeah, I didn't because honestly I don't have a good answer to that at this point. Thank you for following up on that though. It's hard to say. There's no obvious. We can't say like, oh, the high frequency guys were able to hop in and take down all that cheap flow. I mean, that certainly isn't something that we've seen. If anything, it's those types of entities would have loved to have stepped in, just like any of us would. I mean, I would have loved to have taken a day off and trade. I don't know who was in a position to win and understand, because things happen so quickly and happen in such a way that if you were the type of entity that was looking for those opportunities, they happened in such a sudden and severe way that there was no opportunity to really react before hitting those risk parameters that would have prevented them from trading or required a minute or two of analysis before they could have confidence in those levels and reset their markets. And at that point, the opportunity's gone, or the thing's halted for the next 10 minutes and it's either bouncing back or trading down another 20, and then you have another reevaluation. So hard to say. Yes, sir.
You made the point multiple times that the issue was really price versus liquidity. What in the old style market makers were required to provide that liquidity. In today's electronic market, are there requirements or is there a consideration for electronic markets to provide that liquidity that apparently wasn't there?
Yeah, it's another great question, and technically the answer is yes. We have a lead market maker in the ETF world, at least. There's a lead market maker on just about every ETF. SPY is actually one of the few ETFs that does not have a specific designated lead market maker, just because the liquidity is so robust and there's so many participants. It's just not necessary or feasible to have that. But for most securities, there's a lead market maker that is required to make a two-sided market throughout the day. I think the general driver of the current market structure and the logical understanding that most people approach that question with is there's an arbitrage opportunity. There should be an economic incentive for people to step in and offer liquidity. And we've heard, again, from many different perspectives and many different client types that they would have loved to have stepped in and provided liquidity, but the market structure simply didn't allow them to do that because things were happening in very, very small fractions of a second. So the answer is, under most circumstances, again, 99.9% of the time, we tend to see an incentive for market makers to step in, an economic incentive, very clear. Some of the exchanges are working on programs or have programs in place that allow for the exchange to pay certain market makers a certain amount for things like being on the inside of the market the most out of the day. If I'm on the inside 52% of the time, I get a certain bonus for that day. Trying to find ways to incentivize market makers to come to the table, in addition to the natural advantage of, if I buy something below NAV and can sell the basket at NAV, obviously I have that arbitrage opportunity. One of the big challenges with market structure in general is matching the risk that market participants have to take with the reward that they get for taking that risk. For many reasons, those two things were more closely aligned under the floor-based trading model, under market structure that allowed a little more common sense interaction from humans. But there were certainly opportunities where market order came in to sell and the best bid was down $1, and you would have been very happy to buy it down 50 cents, and you did that. And that was a great trade. There were also circumstances where market order comes in to sell, best bid's down $1, you buy it down 50 cents, and then another larger market order comes down to drive it down even more, and then you're out that amount. So it's really easy to look back and say that would have been a great trade. It's a lot harder than people realize in the heat of the moment to understand what was a great trade and what wasn't. And the ability for, whether it's supply and demand, market dynamics, to provide that match of risk and reward, or the ability for market structure to provide that match of risk and reward, is something that probably the most important general question that remains in the market. Yes, sir.
So, on limit versus market, so let's say there's 1,000 bid at 90. If somebody goes 2,000 market to sell versus somebody goes 2,000 limit 85 to sell, would the market maker react differently to those two order types?
It would. I'm trying to think. If the market maker had the ability to react under the old structure, you're talking about current market structure. Current market structure would go to whoever came in first.
So I'm saying, how the market maker might react to the same. Is there an advantage to using one versus the other in the case in which you're going under the bid?
You're trying to hit the bid, right?
Right.
You're trying to hit the bid either with a market.
Limit, but you're going way below. Right? So over time, is there an advantage to just crushing the limit order or crushing it with the market? That's the question. So
I don't understand what you mean. Sorry, go ahead, elaborate a little more for me.
So 90's the bid, 1,000, you got 2,000 to sell. So you're going to say sell 85 versus somebody else, or in another situation you're going to sell market. How would the market maker take advantage of that?
So in both cases, 1,000 is going to trade at 90, right?
Right.
And then the next 1,000 or the remaining amount is going to trade down whatever the next best bid is, right there.
But we have a time advantage on the order versus market.
There's in current market structure, there's no time advantage, right? So that limit order, it's a marketable limit order, so it's gonna trade instantaneously at whatever's best down to the limit. Now the advantage of using the limit order there is if the next bid below 90 is down at 80, you're not going to sell that remaining 1,000 shares down at 80. Could be that 5 minutes later market rallies back and you get the rest down at 85. The challenge with the market order in that case is you're going to sell 1,000 shares at 90, and then you're going to sell 1,000 at 80. And you say, oh wait, I really didn't want to sell at 80. So that's I think that there should be a pretty simple set of order types that most people utilize. And we constantly work to educate clients on what order types make the most sense in the circumstances that they're trading under. But yeah, it's certainly a situation where we always recommend the use of limit orders just to protect yourself. And things happen so quickly. You may look and see that 90 bid for 1,000, and by the time you get your order in, it hits the market, somebody else has traded there, and the next bid's down. So we always recommend use of limit orders.
I know there's going to be some type of regulatory result. It sounds like there might be a type of regulatory result. You think the market itself is going to be captured enough to solve some of the market makers themselves will be able to keep capturing it in order to close it and they'll take some counter regulatory?
I think there will always be a market response to whatever regulators or the exchanges dictate the rules to be. Market makers will always optimize their experience under whatever the rules are laid out. Yeah, no, and that's certainly something that I know a lot of market makers are looking to do. Something like why didn't you just bid for 1 million shares down 4.9% if you knew the band was 5%? You know, that sounds great. Until Apple's down 10% and you're willing to buy 1 million shares of something down 4.9, and your risk guy is standing over your shoulder saying, you know, you're taking on a lot of risk there in a set of circumstances that it doesn't give me a lot of confidence. So yes, there will be responses from market makers. There already have been, I'm sure, tweaks to market maker systems that provide some sort of protection, or some of the flip side of protection, the ability for them to capitalize on those opportunities. But there will be responses from all sides. There will be responses from market makers that we may not be aware of until we see them in the market. There will be responses from regulators that may mandate that the exchange complex changes rules across the board around things like busting of trades or volatility halt bans or things of that nature. Remains to be seen, but I think there will be a response from many different angles. Yes, sir. Go ahead, sir.
Icon continues to make a lot of noise about entering the high yield market, sending the ETFs more quickly with the underlying market, may or may not be. Do you have a point of view?
I do. Thanks for asking that. It's a great question. One of my favorite topics. So Icon's looking at A and Z, and there's really 24 other letters in between. So what you have with fixed income ETFs, and high yield's a great example, is you have fixed income exposure in a really, really efficient equity-based form, right? And you have a few of the things that limit fixed income from trading that efficiently already solved, right? You have transparency, you have a multitude of different market participants involved all day throughout the day, from mom and pop investors to big institutions to credit hedge funds to a number of other different arbitrage outfits. You have a diversified underlying basket. So rather than saying I need to find this one specific QSIP, you have 800 QSIPs and some flexibility in the creation and redemption process that I'm happy to talk about after the fact because I know we're running up on time. But what you essentially have, and I had a great conversation a couple of years back where we showed the spread on high yield at the time was 120 basis points. And the spread on our high yield fund J&K was 4 basis points. And the question was, well, how do you reconcile those? That doesn't make any sense, right? You're showing me amazing liquidity on an illiquid underlying basket. And the key to that is the market structure of ETFs and the multitude of investors that play in that space. You also have an issue of timing that comes into play where if someone is selling a bond or selling a mutual fund, that hits the underlying bond immediately. If someone's selling ETF shares, you can sell $10 million worth of J&K exposure at 10 a.m. By 2 p.m., there's somebody else who's buying that exposure. And you have no instance of that change of interest in high yield hitting the underlying market. Only about 15 to 20% of trades on our high yield fund, on average, result in primary market activity. So there's an exchange of exposure that takes place in a very efficient manner that doesn't end up having an ultimate impact on the underlying securities, which is good in a number of ways because the costs associated with trading those underlying securities, the spreads involved, the operational costs are very high relative to the ETF. So we certainly see a band within which we expect high yield ETFs to trade, but they'll trade at a very tight spread within that band depending on circumstances. And to the extent they bump up against an outer limit of that band, there's going to be an arbitrage opportunity. So there's a little bit of a kind of backstop in place there.
Do you have any comment on the Guggenheim equal-weighted RSP that was holding the trade for a significant amount of time, right? How long was it holding, and what was the outcome of something like that?
Yeah, unfortunately, I'm not really up to date on the specifics of that specific circumstance on that specific product. We tend to let other providers, comment on the activity in their own products, just as we're, always happy to comment on activity in our product. But unfortunately, I don't have a lot of specific detail on that situation for you.